Hi there, clients and friends. Mike Brady here with Generosity Wealth Management, a comprehensive, full-service wealth management firm right here in Boulder, Colorado. And today's conversation is about whether we ought to run for the hills, find that ledge and jump off it. Because if you've been watching or reading the news recently, the volatility has gone up in the unmanaged stock market indexes and some of the bond markets as well. And and they've decreased. And the answer is no. I don't believe that we should jump off that ledge. And I think this is a short-term correction to what we've seen. Let's talk about the unmanaged stock market indexes first and foremost. Your S&Ps, your Dows, your Nasdaq, etc. I'm going to put a chart up there on the screen, and if you have been watching my videos for a long time, you're very familiar with this chart. It is normal for there to be intra-year declines throughout the year, going back years and years and years. Every year there is one, and every time there is one, we always freak out and forget that that's a normal thing. And I think this is going to be one more of those normal things, not the beginning of some huge decline where we lose 20, 30, 40%. I just don't see that with all of my analysis. And I also think that it's going to be relatively short-lived as well. Let's talk about the bond markets. The yields have spiked up in relation to the bond prices going down. Back in June, Ben Bernanke, who's the chairman of the Federal Reserve, he made some comments about starting to taper off. Now, of course, he's taken all summer to kind of back off some of those comments. But essentially, let's think about money in the economy as money in a bowl. Here, kind of look at my hands there. Money in a bowl, and you can put money into it, you can take money out of it. And so for the last 4 or 5 years, we have definitely been putting money in there by decreasing the interest rates, but also doing a bond repurchase. What he said back in June was not that we were going to start taking money out of it, or that we were even going to stop one of these two levers of putting money in, the bond repurchase. He just said we're going to put in less, we're going to buy less back, so we're going to put less money in. Also, there's an accumulated amount of money in there already. So I think that the concern is an overreaction, and it took us a long time to fill this bucket with a lot of money. It's going to take a long time for that impact to really be felt. At this point, there's money in there for banks to lend out, and they are definitely doing that at this point. So I think that the reaction, even on the bond market, is an overreaction, and I'm not freaked out about that as well. It is important to have a portfolio that has both stock and bond components. In general, I'm being very general. Each client is different, of course, and the percentage that you have in those two, of course, is specific to what you're trying to do with your particular strategy, whether that's a retirement strategy or a growth strategy, an income strategy, etc. And so the mix between these two, some things zig when the others zag. At this point, the equity markets in general have been up. The bond markets in general have been down. So they're kind of competing forces here. In previous years, it's been reversed, where the bonds have done well and maybe sometimes the stocks at various points have gone down. And so having that mix makes a lot of sense. I'm going to end this video with something that I really like from Warren Buffett. Back in 1975, he wrote a letter to Katharine Graham, who owned the Washington Post, and he basically told her to keep the long view, the long picture in mind. Think of it, as he wrote in the letter, of 1,000 coin tosses, and there are going to be times when 5 or 10 of those are going to be in a row, all heads or all tails, and you might get all excited one way or the other, but it really is just a short time frame that does go back down to normalization. And so it's the same way when we're looking at investments. We're here for the long term. We shouldn't get too excited if there's a month or a quarter or even a year that's up. They do have a tendency to go up and down in value. And the reason why we have investments, of course, is that we assume that the future value will be greater than today, whether that future value is 5 years, 10 years, 20, whatever it might be. Otherwise, why would we have investments? Why would you put it in there? You put it in your mattress or in the bank savings account. So it's important to keep that into consideration, that there are times, both 5, 10 coin tosses, as Warren Buffett says, but we're really kind of looking at it as we're building this portfolio together that works for us with our particular risk tolerance level and what you're really trying to achieve. You've heard me ad nauseum talk about how important the strategy and the retirement analysis and the plan is, and that we then use managers and other investment vehicles in order to support that particular strategy. Let's keep our eye on that particular strategy. Mike Brady, Generosity Wealth Management. There was an awful lot here in a short amount of time, but I like to make my videos short and pithy and to the point. So hopefully today I achieved that. Mike Brady, 303-747-6455. Have a great day. Bye-bye.